Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as stockcharts.com. So today, I want to cover off my year-end review and look forward to 2023. The big thing I want to focus on, I think we have all seen the movie from 2022, we've lived it, but what I want to focus on is where we're going in 2023, because the data that I'm looking at tells us that we really need to be focused on trying to protect our portfolio. So I'll show you a whole bunch of economic indicators for the consumer and focus on some of the bond signals and stock market signals that I'm seeing out there, and allow you to make your own decisions. Obviously, I'll add some color to it, and then you can decide if it should have been black and white. With that, if you like the work we do here on the Market Buzz, I'd appreciate if you head over to ospreystrategic.org and just see what we have to offer. You can see everything we do. There's a lot of free stuff there, but you can also see everything we do for just $7 for a 1-month trial and go in and figure it out. We try to make sure we're protecting capital. That's our number one goal. And there's two of us to help with it, and these are the types of things that you would receive there. But I think most importantly in this bear market, I've tried to keep the clients on side of the market. If the market's going up, we were trying to be in the market, and if the market's going down, we were trying to protect the portfolio or move to cash. And hopefully you'll find that helpful. I think when I look forward, I think we're going to need some more of that kind of flexibility is probably the right way to do it. So what I've got to start here is the Fed funds rate. And I think this is the single biggest issue that most people aren't aware of that we need to be aware of. And I've mentioned it a couple of times, but I'm going to take it from this chart and put it into perspective from a variety of different data sources and lay out what this could mean to us. So first of all, up here is the federal funds rate. And this still doesn't have the other 0.5% from Wednesday on it, but it should have it shortly. I would just say that the rate of change already from 0.15 or whatever to now is up 4,600%. What I want to put in context is our previous kind of rate of change for 12 months was 200%, so a doubling at any point in time. And here we've smoked it. We've gone up a lot. Now, even if we had started at 1%, we're at, we've gone up 5,000, so call it 500% to get to the 5% target that the Fed's talking about in 1 year. And the main issue that I have with that is the rate of change is so high. And in 2010 to 2018, we made a 2% move in the interest rate from 1.11 down here to 2.4. And during that move, we took 8 years to get there. In 2004, we went from 1% to 5%. And again, we got into the point where it was roughly doubling. And that was a pretty excessive move. And again, that ended up in the financial crisis of 2007. So that was pretty sudden. Here we have just moved so far, and what you see on this PPO indicator is the waves are getting bigger and bigger, and I've spoken about this before, but to me it feels like a flywheel that's getting off balance and it's starting to wobble a lot. We are trying to do it faster or slower or bigger or smaller, and by doing all of these wild swings, we're continually creating instability in the longer picture. So that's my main thesis today, is what the Fed funds rate is doing. And I think it's already having an effect on the market. We just haven't seen it in the data yet. So I'm going to try and point out some of that data now over the next few minutes here. So first of all, I want to start with single family unit houses sold. And what's really important here, in the 70s, you can draw an uptrend. In the late 70s, you could draw an uptrend, and this was a housing top. And I'm going to talk about this period of time, 75 to 82, quite a bit. So just remember that we kind of ran up, and then we actually had 2 recessions in there. And then in 85, we ran up, and we just worked our way sideways for a while. But then when we broke down, we had another recession. And then in 2000, didn't have anything really to speak about, but we did have the run into '05 and then the big collapse. Now, obviously, there were other issues there, but my main point is we've broken the uptrend again. So uptrend, uptrend. I wish it didn't have this little bubble here. Uptrend and uptrend. All of these, every time the uptrend breaks, it's important to recognize we've usually ended up in a recession. And in this particular case, the uptrend, well, maybe it did break, but it went sideways. We still ended up in a recession. We have a big uptrend here that's broken. We've also got a sideways, and we're starting to make lower lows. But more my concern is this is just one piece of the puzzle. And because the mortgage rate is rising so fast, this is creating pressure on the home market. And it's believed that the home builders make up about 18% of the economy, not just the construction of homes, but everything that goes into the homes, the floors, the walls, the pictures, the appliances, the bathroom fixtures, the tubs, the showers, closets, cement, you name it. It's all in there. So this is a big deal to start to see this really start to slow down. Now, when we go look at autos, so the two biggest things that typically most people buy would be a house and an auto with borrowed money. And what we see here is global, this is from S&P Global, global auto production slumps in November amid declining demand. And if you were trying to buy a vehicle earlier in 2022, you might remember you'd go to a dealership, they didn't have anything in stock. If you wanted to, you paid a premium. I think I saw one with a Dodge pickup truck. This was from on my Twitter feed, but it was literally a $50,000 market differential on it. And now all of a sudden the dealers have these prices on vehicles that are full step change, 40 grand higher than they used to be just 2 or 3 years ago. And for some reason that's all just going to get worked in. But I think the bigger issue is these three words, amid declining demand, and we're starting to see the output index continue to drop here, and collapse of European demand drives global deterioration. But it doesn't matter if we're talking global, Asia, or Europe. We're still seeing everything fall here. And we're at levels, I'll call it, consistent that were all the way from 2012 onward. We're now, all three of these are kind of below that main level there. So autos being this, I'll call it undesired, is a pretty big deal. Now, when I go to my local Ford dealer, he's already got $3,000 off MSRP. And again, these are the 2022 trucks. But notice the financing rate. So they're knocking the MSRP down. They're also changing the financing. Really, it would be between 7 and 9%, and they're putting it at 1.5%. So that just means they're taking more margin out of the vehicle and using it to pay the interest rate. But even as you work through their product line, what used to be happening was the car lot was empty, and you took what they had and they added a bunch of dealer options on there that you may or may not have wanted. What we're finding now is the lot is full, and all of a sudden this is starting to change quickly. So if you, as one of my friends in the car business said, if you can't sell the steak, you can't sell the sizzle if you can't sell the steak. And that's the big issue here, is that first of all, the price of vehicles have gone up a lot. The interest rates on these vehicles have gone up a lot. And we see this sudden rate of change by the Fed, I think, really changing how fast people can adapt. And we have wage inflation coming from across the board. I think the pilots got around 30% over 3 years. That's a big deal. We're seeing unions asking for 6% for this year and forward years. All of these things are adding up to put a lot of pressure on trying to get this rate of inflation down. I think we know some of that, but it's starting to show up in the home data, like I showed you already, and now the car data with this decline is starting to take place. So I think it's particularly important that we're aware of these changes. Now, one of the other areas that we should start to see the change, and I want to point out two things on this chart, not just what's currently going on, but what has gone on. There was a regular climb in retail, and then all of a sudden we literally had a moonshot. So whatever, if this was pick a number, from 300 to 450 over a 20-year period. Here we are, we went from, I don't want to use the exact bottom, but if we went from, let's say, 450 to 600 here, all in 2 years, it's been a remarkable rate of change. And that rate of change is slowing. And so when we start to just zoom in on this, what we notice is that this is actually flattening out here. And really, since the Fed started to raise interest rates in January, February, it didn't take long after for this to fall apart. Now, I could draw an uptrend line here and it would be starting to break. I would just say that we've gone flat, but what we did expect was retail to increase heading into December, and when the November data came out, it was actually a decline. I think what's more important is it's the third decline in the last 5, and so we're starting to see a change in this indicator at a critical time of year. So is it just short term and it won't be a big deal? Well, that is really an interesting question. But when I look around, what I'm starting to see is this is the total home equity lines of credit. And what we see here, we haven't done anything on this chart for pretty much 12 years. All of a sudden, this thing is starting to spike, and we're starting to see it at elevated levels that we saw back in 2000. Not quite at the levels we saw in 2008, but nonetheless still changing. Now, this was last updated December 13th, so this is the most recent data, but it's still right up there. It did tick down slightly, but I think we have to appreciate that this is a pretty sudden change, and all of a sudden, as this interest rate has changed from the Fed, people are dipping into lines of credit to kind of keep their lifestyle going. When we look at what's going on with the banks, this is banks tightening standards for credit card loans. And what we see here is, if we look through the period 2010 to 2018, and remember the Fed was doing a modest rate increase there from 0.1 to 2.4. We saw this long period of time, but this the banks would start to tighten their credit standards towards the late end of this. Well, now here we sit, and this reading is the only other 2 times in the last 20 years it's gotten up here. One was COVID. Before that was the 08 financial crisis, and the I want to call it the tech inflection in 2000, or the Y2K market top. But we got up here, and then all of a sudden things started to run on until we made it to the bottom of the stock market decline, and then things started to improve. So we're still climbing here. There's no sign of this changing. It was last updated in November, so we should see some new data coming out pretty quick. But to me, this is a flag when you add it on to the home equity line of credit data, telling us that things are starting to get more compressed for consumers. And if we work through and look, this is a financial page from S&P Global Ratings, but they talk about the situation, and some of these are about corporations, business conditions, and corporate profits, but this is specific to borrowers' debt service capacity. And what it says is the risk level is now high, only very high above that, but it is getting worse. And so it's these types of things that are starting to accelerate. And again, we're at the early end of this Fed deal, because it normally takes about a year for us to see changes in the Fed's actions start to hit the market. Well, I think it's happened so fast that the data I'm showing you is already breaking. And so for me in particular, I really expect this to be a sudden shift where I think it was Morgan Stanley on TV the other day, and they said, one of the things about the consumer, it's a bit of a light switch. They go, and then they literally just flick off when things get too bad. And they're worried about that event starting to happen because of the way things are changing. So when we look at the University of Michigan consumer sentiment, this tends to follow gasoline prices a little bit now, albeit can't really overlay the charts. But what you see is when gasoline's expensive, people are really, consumer sentiment is negative. When gasoline prices improve, then things start to improve. And we've pretty much seen that in 2022. This chart goes all the way back to 1978. My main point here is we're down at the worst level in 40 years when inflation was really, really high. And again, I mentioned that I wanted to talk specifically about that 75 to 82 period that we saw on new home sales, and that was in here, 75 to 82. And what happened is once we started to break this trend here, we really saw two recessions show up in 1980 and 1982. But we're sitting here at one of the worst levels for consumer sentiment. And again, their credit cards are starting to get pinched. They're taking out lines of credit. Their retail sales are starting to flatten out. Car sales are starting to change. Home sales are changing. All of this is showing the consumer under more pressure than we might otherwise expect. And with that, can we really see this consumer sentiment starting to improve if their debt levels are starting to be pinched? And again, we got grocery issues, and for most people, you've got grocery, utilities, the actual mortgage payment, you've got the car payment, and then you've got the things that you would add on top of those things. The car kind of can get squeezed out by the first three, but definitely the move to holidays and entertainment and all that kind of stuff is going to get squeezed out. So if we put pressure on the car and on the I'll call it the regular lifestyle stuff, that's a big deal. And now we're down to the final three. So it's this change in interest rate and the consumer really, at 40-year lows. That tells us something here that we need to be aware of. I know a lot of people think that the interest rate hikes are by the bond market are done. But the one thing I would say is this is just starting to show up in my chart. And this was one of the charts I shared with my subscribers this week. Portfolio managers are all talking about getting long bonds here. Well, the time to get long bonds is up here before these downtrends start, not at the bottom before these uptrends start. And right now, the 30-year bond is literally bouncing off this line. It's made two spinning top candles, and we've started the week of December 19th moving higher. And to me, I think this takes off to the upside again to kind of catch up to with where the Fed is for longer. And so on that perspective, if this is going to start turning up, I expect the stock market to actually really struggle. We bottomed as this topped, and we've topped as this has bottomed. Same thing back here. So I don't want to be unaware of the change in the bond market. And again, it could be that the short bonds do something, the 1, 2, and 3 year, but the 10 and 20 year, 30-year stuff, if this is all going to start to go higher, I think this puts more pressure on the consumer again, and then we start to really have trouble here. So the next thing that I'd like to cover off, when we look at the spread between the 10-year and the 2-year, the 30-year and the 3-month, and all of those different types of bond metrics, whether you understand how the bond market works or not, I would just say that these touches below the red line have all been during recessionary periods. So here's the 89-90, and we had the recession of the 90s in there. This is the 2000-2001 period. Obviously, that was a different time frame. And then 07, we had the same thing. Now, it's actually when this starts to turn up that the stock market breaks. And so that is an important component of this message here, is that when the stock market struggles with the change in interest rates or in the yield curve, we need to be aware of it. So first of all, in 2000, the swing started to get bigger as we got longer. Same thing in 2007 and 8. But again, as we went back above this line, that's when the real pressure started to show up. Now here we are. We've already had a decline. We've bounced back up. I don't want to say we're near our prior highs, but we're not far away. And this is still at a very extended level. Now, if this is going to start to shoot back, I want to revert to this Fed chart. This is an unprecedented rate of change. So I don't really want to just kind of ignore that this could be a meaningful spike back up and relatively quick. which is what caused the problems in '07 and in 2001. It's that dynamic that we're dealing with when I look across the markets. So those are kind of the background. So how does that affect the stock market for our investments? First of all, I would just say I'm still worried about the long-term bond, because if we're going to bounce back up here, recognizing that the Fed's going to have trouble getting inflation under control, and these are going to be higher for longer. If those start to move up, I expect the stock market to really struggle here, and all of those charts I showed you about the consumer to probably go under even more pressure. So here's the NASDAQ 100, and one of the things that's interesting about this chart, if you look in 1990 to 1991, the momentum indicator fell all the way down around the zero level and stayed above zero for a long time. And then in 2000 and 2001, we dipped below there and we stayed down there for a couple of years. In '07, '08, as we started to get into the middle of '08, this got down near the zero line and continued its way down. Well, here we sit at December of 2022, and we're already below zero, right? We're at negative numbers. So we're doing something that was only seen in the NASDAQ stock market in the big pullbacks in 2000 and 2007. Those major market events are the only two times we've seen a PPO on the NASDAQ this week. What is the PPO? It's the momentum indicator for price moves in the stock. And what we're saying here is that this is moving down at such a fast rate. Momentum is negative, and it will take a while for us to kind of stop the decline. Now, the other thing you'll notice is when the NASDAQ, this is a monthly chart, when it starts to touch the lower Bollinger Bands, if it can bounce here, that's a kind of a good thing. We've started to touch this 6 months ago, and we're not bouncing yet. So one of the concerns is once you're under the middle of this blue line and starting to rub the lower Bollinger Band, you can spend a long time here below this area, and we did this in '07, '08, where we went down and took almost a year to get back above. But once you start rubbing this lower Bollinger Band and can't bounce off it, that's probably a bigger clue. So we're doing that right now here on the NASDAQ. Now, I can go show you the S&P 500, and it's not quite as dire, but we're still down at a lower level than we've been at for 10 years. Definitely telling us that something on the chart is changing. The entire bull market run from '83 to 2001 didn't get as low as we currently are. So we're in a situation, if you just picked the big recession, 74, 75, and then the stock market didn't do anything all the way through that period. And we've dipped down here. We continued to go lower in 2000 to 2003 and 2008, 2009. Both of those were big. All of this adds up to me that we're in one of these and we're still early in the game. And so I want to be very prepared for it. So my main thesis is whether the stock market is going to do this. These are shapes from other periods of time. This is our current shape of the stock market. Whether we're going to go through some nasty downfall, I don't know. But I will just say that when we look through the stock market history, even if we go back to the 1975 period, I think I have it here somewhere. Yeah, here's the 1972 to 1982 period. We were flat and we just swung around. And it was very difficult for people to make any real money in the stock market. So my goal here is to try and tell people this was an inflationary period where the stock market was very choppy. And in order to make money, you needed to have signals that helped you get in the market in a timely fashion and get out to protect your capital. Will we go through this long-running uptrend from 1982 to 2000, that kind of big uptrend? Well, I'm telling you that on both the S&P 500 and the NASDAQ 100, our PPO is at levels suggesting we're below that type of stock market behavior, and we're probably more inclined for a rough ride over the next period of time until this inflation does in fact get under control. And the Fed has told us they have no intention of moderating their expectations just yet. The market believes the Fed will have to, but at some point, we also have the issue of the governments can't afford a high level of debt, so that inflation rate has to come down in order for our governments to be able to afford to provide the services that they normally do. With that, I'd like you to head over to Osprey Strategic, check out the stuff we do, where my Schnell strength indexes are right now. For clients, just very briefly, here's my conclusion for the week ending December 16th. Global markets are breaking down in unison. Banks are breaking down full caution. I don't want to be weekly here. I'm trying to talk about the bigger picture, but I think it's really important that whoever is following the market, that you do have a tool to help you ride the uptrends, make money when you can, and protect your portfolio or get out when you see the market roll down. Because otherwise, I think you could end up having like a big 5-year slide sideways, and it doesn't really help you. Thanks, everybody. Have a good week. Have a great 2023 and enjoy the holidays. Wishing you all the best. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.